Imagine you're a street vendor selling chai. You're good at it, people love your chai. But you need a small loan to buy more milk, more sugar, maybe a new stove. You go to a big bank, they laugh. You go to a moneylender, they charge crazy interest. What do? That's where microfinance comes in. It's like a small loan, specially designed for people like you. Small businesses, low income, no collateral. It's helped millions around the world. Microfinance is about empowering people, giving them a chance to improve their lives. But like everything else, too much of a good thing can be bad. That's what's happening in UP and Bihar. Uttar Pradesh, Bihar, two of India's most populous states. Lots of people here depend on small businesses, farming, weaving, pottery, you name it. And many of them don't have access to regular banks. Microfinance saw a huge opportunity here. They stepped in, started giving out loans, and people loved it. They could finally expand their businesses, improve their lives. But then, the numbers started getting out of hand. More and more loans, faster and faster. Everyone wanted a piece of the pie. Borrowers took multiple loans, often without understanding the risks. Now the Reserve Bank of India, RBI, is worried. They see what's happening in UP and Bihar. They're worried about two things. First, high indebtedness. People are taking on more debt than they can handle. They're borrowing from multiple lenders, getting trapped in a cycle of loans. Second, risk to the whole financial system. If too many borrowers default, it could hurt the entire microfinance sector. And that would be bad for everyone, especially the poor who rely on it. The RBI knows microfinance is important, but they also know it needs to be sustainable. They need to find a way to balance growth with responsibility. Section 4. Real-world repercussions. Stories from the ground. Take the story of Shanti Devi, a farmer in Uttar Pradesh. She took multiple loans to buy seeds and fertilizers, hoping for a bumper harvest. But the rains failed, the crops withered, and she couldn't repay her loans. Now she's trapped in a debt spiral, her livelihood at stake. Or consider the case of Ramu, a weaver in Bihar. He took a loan to buy a new loom, expecting higher earnings. But the market got flooded with cheaper machine-made fabrics, and his income dwindled. He's struggling to repay his loan, his dream of a better life shattered. These are just two examples of the human cost of unchecked microfinance growth. The RBI sees these stories and they know they need to act. Section 5. What can RBI do? Playing the balancing act. The RBI has a tough job. They need to control the growth of microfinance without killing it. They need to protect borrowers without discouraging lenders. So, what can they do? First, stricter rules. They can set limits on how much people can borrow, how many loans they can take at once. They can also make sure lenders are being transparent, explaining the terms clearly. Second, promote financial literacy. Teach people about debt, about interest rates, about responsible borrowing. Make them aware of the risks involved. Third, encourage other forms of finance. Support self-help groups, cooperative societies, and other models that empower communities. Section 6. Striking a balance. Protecting borrowers, ensuring growth. The situation in Uttar Pradesh and Bihar is a wake-up call. It shows that even with good intentions, things can go wrong. Microfinance is a powerful tool, but it needs to be used responsibly. The RBI has a crucial role to play in ensuring this. By taking the right steps, they can protect borrowers, ensure the stability of the financial system, and allow microfinance to continue its mission of empowering the poor. It's about finding that sweet spot where everyone benefits and nobody gets hurt.